So there are many of you guys that are going to struggle with the new paradigm being established this year in stocks, and that means you need to change your portfolio right now. Now in sports, you can't trot the same players out, the same everything if the rules and the conditions have changed, and stocks are no different. I mean, do you need to change your whole roster? I mean, for some of you, this past year was a disaster and that's what you need to do. But for most, it was an incredible year, but even the champs, the big time, the winners of the championship make changes to get better. So these are the changes that you need to make to get the most out of your portfolio right now. Just make sure you like the video if you like getting the truth without the hype, because that's exactly what you're going to get today. But these are the 5 changes you need to make to your portfolio right now. And the last one is absolutely critical. Even if you don't do the other ones, fine. I get it. Totally understand that. Make sure you do the last one. So number 1 is to clean up your portfolio. So it seems like a lot of people bought a lot of stocks, and my guess is they were chasing this hype stock or that hype stock, especially there towards the end of the year where it just seemed like stocks were popping off everywhere and everybody's wondering, hey, should I buy this? Should I buy that? Whatever the case is. Now, some of those have paid off, others not so much. And I've seen people in my group who've joined who over the course of time, they'd accumulated more than 100 stocks in their portfolio. Now, we successfully got them down to, basically a handful of core positions and maybe some bonus stocks to hit certain goals. But if you're in that spot there, you definitely need to make huge, massive adjustments to your portfolio. And again, if you want help with that, the holiday sale is ending this weekend and the price goes up forever. So now is the time to join. If you want to see all my buy and sell alerts in real time, my complete watch list with price targets, you got 5 courses for free coaching. So much, guys. We'll talk more about it at the end. Check it out. It's the pinned comment down there. But if you bought a lot of junk and you've accumulated a lot of stocks that you don't understand, that don't fit your goals, don't fit your plan, don't fit anything else, you absolutely need to look at trimming down the size of your portfolio significantly, not in terms of dollar amount, but in terms of the number of stocks owned. So number 2, change the level of risk in your portfolio. Guys, it is critical you have the appropriate level of risk in your portfolio. I see it constantly where too many people have too risky of a portfolio still, even after the disaster of 2022 with the 2021, bundle of stocks and risky stocks that they bought, they still have a complete disaster on their hands and they don't know it. Basically, I'll see something like they have 10 stocks, but 8 are speculative, non-profitable, and in some cases, no path to profitability type stocks, and your quote unquote safe stocks are Tesla and Palantir. That is not a safe portfolio. That is a speculative portfolio. Now, I love both Tesla and Palantir. I own a ton of both. They are huge pillars in my portfolio. But they are not safe stocks like an Apple or a Microsoft or a Walmart or a Coca-Cola or something like that. They just aren't, guys. I'm sorry. I know there's lots of YouTubers out there saying that they're not. They are not safe stocks like those other stocks are. Now, again, like I said, I own both Palantir and Tesla, but my other core positions are not speculative and not non-profitable companies with no defined path to profitability or anything else like that. I own some of those, but it's a very, very small part of my portfolio. But if that makes up the vast majority of your portfolio, that is speculation. That is not investing at that stage. Even with 2 great investments in there like Palantir and Tesla, you still are speculating, and that ends up poorly every single time. It never ends badly in the end. So you got to change that up. Number 3, change your outlook on money and put more into your portfolio. You cannot grow and build real long-term wealth without steadily putting money into your portfolio. I have never seen a great portfolio built any other way other than that. But so many people view investing as a one-shot, type of deal. I'm just basically going to put a whole bunch in, and then I'm going to put $10,000 in, it's going to turn into 10 million later on. That is never how it works. That is never how it goes in the end. I call that lottery investing, and you might as well just play the lottery instead, because that's exactly what you're trying to do. It's not a prudent way of investing, and it's not a way to build wealth long term. The other thing that I see people do is they use investing as a way to kind of solve their money problem, and that means they end up trading. And guess what? It's not going to solve your money problem. It's going to make things worse. If you have bad money habits over here, at some point in time, taking those profits and moving it over here to do something else and to spend more in the end, or whatever the case is going to happen. And more importantly, you're just not addressing the actual problems with your money in the first place and your ability to manage your money in the first place. You got to start eliminating some things from your budget. That's kind of the first thing. Get a steady flow coming in each pay period, even if it's just $100. That's it, just $100. That will grow over time as you continue to get better with your money, as you continue to get better with your budget. Consider house hacking. Cut back on unnecessary expenses. cut back on necessary subscriptions, cut back on expenses with your vehicles. All those other things of that nature. There's tons of videos out here on YouTube. You don't need me to rehash them all, but you got to start mastering that money. And then on the flip side, over here, start that side hustle, work that extra overtime, whatever the heck you need to do. And don't use that money to spend, but use it over here to stack up. Now you're only putting in an extra 100. Maybe you make an extra $500 a paycheck or whatever over here. Great. Put that over here. Put that in there as well. Now you're at 600. Do that all over time. And now you have a steady stream of income coming in for you to be able to invest. So that way you can consistently invest over the course of 20, 30, 40, 50 years, depending upon your age, right? I mean, if you're 40 years old right now, you probably have another 40 years worth of investing to go. You might be retired, obviously. I hope you're retired well ahead of time in regards to that. But you're going to continue to invest even in retirement. And so building those habits right now and understanding those habits and having that money consistently flow in is how you're going to build that wealth over the long term to sustain yourself. Start small and build, but it needs to be steady and it needs to be going up steadily. All right, so 2 more to go. And the last one is the biggest and most important, but we have to get to number 4, which is also important. And that is change the mix of stocks to meet your goals. This is a mistake that I see that can absolutely destroy an otherwise great investment portfolio. You can do every single other piece right. But if you don't set a goal out there, or if you set a goal, but your stocks don't align with that goal, you're going to fail to hit that goal. And that sucks when you do everything else right. So let me give you a few examples here. We have members that are young, come into my group, and they want a multi-million-dollar portfolio. But they're asking and looking at stocks like Walmart or Coca-Cola. And then on the flip side of that, we have other members that are retired and looking for more income, but they own all growth stocks instead of dividends and REITs and maybe looking at real estate investments or something else of that nature. They don't want growth. They have the money that they need. They're looking for income, but yet they have their money in a Tesla, in a Palantir, in something else like that, instead of in dividends and REITs and stocks that make them reach their goals and actually give them what they need at that particular point in time. If you don't have goals, then you need to set them. That is key to anything you do in life. If you don't have a goal, you're not going to achieve anything because you're not going to know how to get there. You're not going to know if you're on track or off track or anything else of that nature. You won't do it. If you have goals, the stocks you own should aid in getting you to your goals. That's how I judge it. I sit down and I look at it. We do this all the time. We do live events sometimes with my group members there, and inevitably, good group members, been in the group for a long time. We'll sit down, we'll break down their portfolio, put it up there on the board, and put their goals right up there next to it and go, how does this stock, and we'll pick it apart. Hey, they got 8 stocks, we'll say 10 stocks just to make the math easy here. I'll pick up 2 or 3 stocks and go, how does this stock help you hit that goal? Usually they're like, you're right. And I'm like, why did you buy that? I don't know, I like the company, great company. But if it doesn't meet your goal, why do you own the stock? And at that stage it becomes very, very clear. So you got to not only have the goals, not only know what you own, but then you got to make sure that those stocks that you own aid in getting you to those goals. If you don't do that, then you're going to be stuck doing everything right, having everything perfect, taking care of everything, but still not achieving your goals, which is incredibly frustrating. And it's a spot I don't want any of you guys to be in. All right, so here we are. This is the controversial one right here. I'm ready for it. Go ahead, blast me down in the comments. Isn't going to hurt my feelings at all. But for me, number 5, and the biggest change you need to make is to stop looking at your portfolio all day, every day. I know this one is controversial, but hear me out as to why I don't look, why I think you shouldn't look, and why it's preventing a lot of you out there, not all of you, but a lot of you out there from making more money in the market and actually causing you to miss opportunities or make mistakes. Now, the reason why is because emotions are the biggest reason we make mistakes in investing as retail investors. It is by far and away, the number one reason why is emotions. Basically, things like FOMOing in and panic selling are retail favorites to do. And every single one of us, myself included, has had those feelings. And more importantly, a lot of times those feelings come from looking at your portfolio in the first place, especially the panic selling. Because when you see a big drop in your portfolio, it gets you scared, right? You see a 6-figure dip in your portfolio, that's a lot of money. That scares you all of a sudden. And the same exact thing works in reverse. That evokes a lot of emotions, right? You see a huge drop, all of a sudden you're scared. All of a sudden you see a year's worth of salary gone. You're like, crap, now I got to work an extra year. All other things like that, those thought processes all start to come into your head. And the same exact thing happens whenever it runs up. You start thinking about taking profits even though that wasn't part of your plan, but you see, that's an extra $100,000. I could do this, I could do that, I could pay off this, I could buy this, more importantly, right? We do that a lot. We're really, really good at figuring out ways to spend our money, but you start doing a lot of things that weren't part of your plan, weren't part of what you wanted to do, but because you looked, emotions come out, and then you start making mistakes. And it gets even scarier to me in an up market like we're in right now, because then some people start to think they have a feel for it. So the good idea fairy kind of shows up and says that you're a great trader and you absolutely can get in and out and really accelerate your wealth. Look, you knew it was kind of on a run right there and you knew it was going to dip. You should have sold and gotten out and then rebought again, and you would have a lot more shares, and you can do that on rinse repeat forever. That's what the good idea fairy shows you, despite the fact that being complete fool's gold. Anytime I'm talking with members in my group out there in real life or anywhere else, the biggest reason for their mistakes is emotions. And those emotions almost always start because they are constantly looking at their portfolios and seeing the swings up and down. And obviously, as your portfolio grows over time, those swings seem bigger and larger because the numbers are bigger and larger the more and more you grow your portfolio over time. Now, let me tell you why I don't look. It was incredibly easy to buy the crash in 2022, and I didn't time the bottom or anything else like that, just to continue to buy the crash regardless of how low it went, because I didn't look at how much I was down. I had no fear because I didn't see that I was most likely down 7 figures at one point or more in my portfolios, kind of across my portfolios there. I never had any fear because I didn't freaking know. I never got defensive and started trying to protect my wealth, but instead I went on offense instead, because that's what you do during a down market. Emotions are telling you to do one thing. The right move every single time during a crash is to go on offense. Every single time. History of the stock market, there's never been a time when the right move wasn't to go on offense whenever a crash happens. And it paid off massively once again as I put more money in the market than ever before in 2022, and have enjoyed massive runs the past 2 years with more money than I ever put in the stock market to start that bull run right there. So that right there is what happens whenever you eliminate those emotions. You eliminate something that creates emotions and you just invest and you do what is right, not what your emotions are telling you. We have members that are up well over 100% for multiple years now. Some of you all out there are in that same exact boat. You have a couple of years now where you've gone up 100+% in your portfolio each year. But let me give you another warning. That can give you overconfidence. And now you get, maybe you don't get into where I think I can trade and things of that nature, but maybe you get a little bit lazy because you are looking daily at your portfolio, and it's natural to start thinking that, hey, I got this. And you're kind of a little bit of an expert. So you start to make little small mistakes. And eventually you stop doing as much work as you were before, and you start taking on more risk because you're overestimating your skills, because you're seeing massive gains year over year over year, or even worse, you start to think you can get 80%, 100% returns every single year because you've done it for 2 years in a row now. And I'm not knocking you. You did a great job, but that is not sustainable long-term, and that is not realistic long-term. And the only reason why you have that thought in the first place is because you looked at your portfolio and you saw those type gains over the past couple of years. And of course you start dreaming, you start doing all the other things that are natural. I do it too sometimes, but you don't come back to reality and go, hey, let me just try to beat the market this year. And if I happen to get above that, that's great. That's all, you end up trying to do in the end, because this is a marathon. It's not a sprint. And for me, over a marathon time, you don't sit there and stare at your watch the entire time you're running a marathon, right? Nobody does that. Sure, when you're sprinting, hey, bang, it's done. If you're an Olympian, I guess you run a 10-second 100 meter. Probably takes me 15, 20 seconds or so. Whatever the case is, the point being, you're looking every 20 seconds. If you're looking at your watch every 20 seconds on a marathon, you're never going to get there in the end. It's going to take for freaking ever, and you don't want to do that, and that's exactly how I view investing. Hey, I'll look at the scoreboard at some point in time later on in the future. For right now, I need to just focus on investing according to my plan and execute to my plan. Take advantage when Wall Street gets stupid, and don't worry about all the other noise that's out there that distracts me from being a better investor. And remember, if you want help with that, the holiday sale is ending this weekend. So make sure you get your spot where you get that free coaching. You get 5 free courses. You get direct access to me anytime you want, live Q&As, be a part of the best 6, 7, and 8-figure Discord out there, helping you become a better investor, and so much more. Make sure you check out the pinned comment and see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.